Hey everybody, this is Paul doing a quick video. Today is November 14th and the market is currently open. As you can see, I'll be clicking around, prices will be moving. So, what I wanted to do was go over my thoughts on what's causing the market rally, where I think we're at kind of in that inflation and recession narrative, kind of where do I think we're going from here. And then also just some thoughts on the inflation report and kind of explain just different things. So, as it currently stands, the Dow Jones itself is up about 14% from basically the end of September till now. My portfolio, not including anything from the day, is up right there and that 16.25%. So been doing had a pretty nice month here, and then I'm also continuing to save up money because I do have taxes and whatnot that I have to pay in December. So haven't contributed much to the portfolio. I'm just letting it just kind of go up by its own gravity here. As you can see, a lot of it's starting to get into the green territory. Getting some really nice returns. So, what caused the rally? What's continuing the rally? And what happened to the inflation narrative? Shouldn't, let's just kind of go from there. So basically, as I pointed out in my last video, the Q3 earnings came in better than expected, and that put a floor under the market. So that gave the market a place to rally from. So it won't go through that floor until the earnings, or at least the estimates of the earnings, go through that floor. So right now we have a floor on this market right around 3,700, I believe, where we could bounce between 3,700 and 4,000 for a while. That seems to be kind of where the floor is at, or it's probably 3,710 or something like that. But and then we also had still good jobs reports. The Fed kind of is doing what the market expects them to do. So, what caused the rally to continue after we got the earnings news? Well, it was the inflation report. And what the inflation report showed is, if we go over here, is it showed a weaker number than most were expecting. Now, housing still went up, or the housing, or OER, which is 40% of the inflation report, went up. The core inflation, the one that the Fed actually pays attention to. But the overall number came down dramatically lower than what the estimates were. So, what caused this issue? Why did the market rally if we're still at 7% inflation? Well, I guess the bears couldn't figure out the difference between a line that's going up and a line that's going down. Very clearly going down. Even Fed members have come out and said, yes, we see that there's very clear data that we're starting to see inflation go the way that we want it to go. That doesn't mean that they're going to cut rates. Don't even start to think that. So, but what it does mean is that the pace of the rate hikes, will we get above 5% on a 2 year? Probably not anymore, or not nearly as fast as we thought we were. So, why do I think inflation's about to drop like a rock in the reports? It's very simple. The last report showed, if you look at it, it showed rents still going up, and it showed housing prices still going up. If you've paid attention whatsoever to any of the data that's coming in from the home builders, the home builders are effectively in a recession right now. They're pretty much dead in the water because nobody can finance their mortgages, or finance new mortgages for sure, at 7%, or close to 8% is where we were getting. That's pretty much a death knell for the U.S. economy. Nobody can pay that amount on a mortgage. It's just not happening. Houses just aren't as cheap as they used to be the last time we had 8% mortgages. So, why is the housing data showing this weird lag to it? So, to explain that, I dug up this chart from September 29th, 2021. And as you can see, This is back when the Federal Reserve said that everything was fine with inflation. There wasn't a single problem, but everybody was starting to scream about it, saying things like, this is out of control. We're seeing rents go up at dramatic rates. But if you look at the official numbers, everybody's perfectly fine. Everybody's happy. What are you talking about? Everything's fine. If you look at the real data coming in from places like Zillow and Apartment List, and you can check this data for yourself. Just go to Zillow or go to Apartment List and just look at the data. You can see, and then this is another chart comparing the two, but this is a chart from almost a year later. And you can see a pretty obvious difference. So, the lagged data is the CPI data. This is why they kept saying inflation or transitory, and then all of a sudden, as you see, it took off like a rocket to match this rocket right here. But look what's happened since they've raised rates. Rents have come down. They've come up a little bit, but they're still down. So instead of being up these dramatic amounts, now they're way down here. So if there is a 5-month delay between these numbers here, what do you think the market is looking at? They're looking at this number coming down like a rock. This is 40% of the inflation report. The estimate right now is, if we keep going at the same pace, 0.2%, that means that inflation's still going up, but the old data is rolling off, then you're going to get down to 2.43. I am fairly confident that there is about to be a barrage, a very large amount of data that comes in, because there is a delay of 5 months. When this number starts to turn, it is going to turn violently and very, very quickly straight down. And then the Federal Reserve is going to be staring in the face of deflation and not inflation. And that is a problem. That's a very big problem. That's a different problem than what we're dealing with right now. But when the reality of the data catches up with them, you're going to see the market price in rate cuts at a very quick pace. I do not see, and you're going to have people that are screaming, the data's not real, the data's not real. The data is very real, and you can look at it right now. Like I said, you can go to either one of these sites and look at this data and confirm anything that's going on here. Just compare rent prices of one place to another, that type of thing. And then in some areas, it's already very negative. You've already got eviction rates up by a lot, especially in the major cities that saw the biggest increases. So it's just basically the big cities. So you can tell where this is kind of going. So right now, if you look at this, by June of 2023, if you even go by just 0.2%, this is assuming inflation keeps going up by a normal amount, 0.2%. You still get down to this, but you're going to have a Fed funds rate sitting at almost 5% if you go by what the Federal Reserve is saying. If you get any negative months, this is what you look at. If you get any negative, so this is how dramatically fast this is going to happen. When this data starts to roll over, these Fed fund futures, this amount right here is going to drop like a rock. Because if you just look at it, negative CPI like this is really, really bad. This is the stuff that Japan dealt with for decades to try and even get their inflation back up. You don't want this. You kind of want a healthy rate. You kind like the Fed wants their year over year number to kind of look like this. The 2.1, they want it to be at 2%. That's where they want inflation to be. The problem is they're going to be staring at this pretty soon. And they're going to realize very quickly that they over tighten, and they're going to have to admit it. That's why they're talking about they're kind of giving much more hints that, oh yeah, we're gonna pause type situation. We're gonna pause, like things are gonna pause. The problem is you're starting to see very big employers going into the holiday season, like Amazon, starting to say things like, we're cutting 10,000 positions. We have to maintain our margins. Basically telling the market, like, we have to borrow at these rates right here. This is kind of starting to come to fruition right here. I just don't. By the time 2023 is over, I don't think inflation is going to be the story. I don't even think it's going to be the story halfway. I think deflation is going to be the story that everybody's talking about because the Fed has over tightened. It is very obvious they've over tightened. They're relying on very old data, which is 5 months out of date. And once this number starts to turn, it is going to turn in a major way. And it's going to start to turn in 2023. And it looks like we're going to get a Republican House and a Democrat Senate. So you effectively have gridlock. That's kind of where we're at right now. So you're going to see this inflation number turn, I think, pretty quick. Now, Mike Wilson came out today, like he always does, and he said that basically he expects the recession to start at the beginning of Q1. So you would start to see more job layoffs around that point. That's when the jobs report turns. If you get one negative jobs report, this entire market's going to do. It's going to do. I'm not exactly sure what the market's going to do, to be honest with you, because that's probably going to be good news for the market because it's going to look at it as basically, oh, the rates are coming down. So you're going to see these rates, these expectations of rates come down like a rock very, very quickly. This went from 4.25 to 3.8% in less than a day. And that's why the market shot up almost 1,000 points, or at least the Dow did. So tech might end up being the big winner in 2023, the big sleeper that nobody's thinking about as the real economy starts to really deteriorate. It all depends on how fast the Federal Reserve acknowledges that we've beat this. So that's kind of where we're at. And the Federal Reserve officials are starting to contradict themselves. One of them came out, I think it was Fed's Waller, did an interview in Australia or something where he said the market got so far ahead of itself and that big market rally, and that shouldn't have happened. And like we're not even beginning to fight the fight on inflation. Just these weird things. And then he literally said, but we expect to do 50 in December. So the market priced in from 75 to 50. He said he's like, oh, that's not what inflation is supposed to do. And he says, we don't want the market to rally like that, but then we're also going to do exactly what you expect us to do. So they're losing credibility as it becomes time for them to either put up or shut up with the tough language. Either you're going to do 75 and you're going to be this tough guy and you're going to keep hiking until you see everything crash, or the market's going to call your bluff. And right now, the market has called their bluff. That's what this is. This was approaching 4.9% or 4.8%. It was getting really close up there. And then it completely dropped 30 basis points in one day. So that's why the market rallied. I believe once you see OER housing data, the rent data, which should start to drop soon, as soon as this turns, you're going to see the market take off like a rocket again. I think we break 4,200 probably. Because you're just going to see rates come off in a very, very, very big way. Because the market, I don't know what the Fed is pretending like this isn't real. But they know that this is real. They've even referred to this before. They know that there's a lag in the data, which is why they're starting to talk about 50 in December, then a pause. Or 50 in December, maybe 25 in January, then a pause. But the problem is while they're paused, the real estate market is dying. People are like stuck where they're at. They can't sell their houses. The refi market's dying. Like a lot of these, like just you're starting to see the slowdown in the real economy kind of translate too. Even Amazon, because people can't just use their houses like a credit card anymore. That's something else that's going on too. So that's kind of where we're at right now. I believe the market rally continues. We squeezed a lot out of the current market rally as it stands right now. Like 4,100 might be the current top and 3,700 might be the current bottom. If we avoid a recession, then the bottom's in. Uh, if we avoid a recession, that's a big if. The Fed would have to recognize very quickly once inflation data starts to turn that they need to cut rates, and they need to cut rates quick so that the housing market can start to recover. If the housing market starts to recover, we can avoid a recession, and you might be able to avoid some things. Like if this area right here would end up being your market bottom, uh, whatever that whatever that big drop right prior to that October run up was. It wasn't June because we went lower, but right in here, this little area right up in here where we had those big drops down into like 3,400, 3,500, that might end up being your market bottom for this time around if we avoid a recession. If we don't and earnings start to take a hint, that's where you start to see we break much, much lower. But the Fed would have to ignore inflation coming down like a rock. If they keep rates at 4%, so this is the problem. If they keep rates at 4% until this number says 2 or 5% or whatever they're going to, we're going to have a major problem because this is going to be a big crash pretty soon. So by March, we're going to be at 4% or much, much lower. So you're going to start to see this data turn very, very quickly. And if you get a negative reading, you're gonna see this data turn very, very quickly on you. So the Q1, we could actually see a market rally into an economy that's weakening because the data is turning in a big way. Rates are coming down as the real effects of what the Federal Reserve did is starting to be felt in the economy. But hopefully we're talking about rate cuts middle of or beginning of next year, maybe Q2 in here, something, because they can't hold it. They can't hold it this high for that long. We're gonna just have too many problems. They're just gonna run into way too many problems with the economy being just kind of put at a standstill for that long. So yeah, so that's kind of where we're at right now. I think that's where we're at. Am I adding positions right now? If I add any positions, it would probably be into anything that's still cheap, I would think. So anything I think that could possibly recover in a lower rate environment. So Intel's sitting at a 9.5 or 9 price to earnings ratio. Um, just pretty much anything below 15 is what I would like to add to. So you see how CVS is there. Here's Walgreens. So you see Walgreens, perfect good example. This is one that has rallied a significant amount off of the bottom where I was buying a lot of them at. As you can see, 25% on this one share right here alone when I bought it at 32. But it's still cheaply valued. It could still go up to 55 possibly. It can still go up a lot. Um, O is one I'll always add to. I wouldn't mind adding to regions, but this is going to start to suffer as rates go lower. Um, yeah, so we have to definitely CHD. No, can't do CHD. See, you're just running into the problem is that the stocks that benefited as rates were going up are the ones that are going to get hurt as rates go down, as money shifts out, because money wants to go back to tech. That's where it likes being. So probably KB Homes would be a good example. It's sitting at a 4. This is one that could benefit in a very major way. Right here, KB Homes could easily be a big, big beneficiary in the beginning of Q1. Even though their actual earnings are going to come in trash, the market will rush back into that stock the same way that it rushed back into Walgreens in less than a week, as it expects that it's going to recover very quickly. So yeah, that's a few that I can see, but it has to have a low price to earnings. Just in case we do start to see severe job losses, like real job losses start to come through, that could be a major problem. So that's kind of where we're at right now. Just kind of stay defensive is what I'm doing right now. If the Feds keeps ignoring the data, we could very easily get that recession at the beginning of the starting in probably Q2, going through most of 2023. So we'll have to see where we go from there. But that's pretty much my video right now, and y'all have a nice day. Leave any comments, of course, and thank y'all all for watching.